So it's that time of year, you start getting your quarterly statements in the mail, maybe from your financial advisor, but definitely probably for most of us from our 401k plans. And we start opening the statements, we go, oh my gosh, we've lost so much money this year. And the S&P 500 has had a good couple of weeks in rebounding, but year to date, we're still down over 15%. So one of the questions that we see a lot is, should retirees or people close to retirement start moving money out of the stock market into cash? Because remember, bonds are down double digits this year as well because of rising interest rates. And the answer is no. No, you don't want to do that, because ultimately you're really shortchanging yourself for the future. You're never going to make up that loss if you're sitting in cash. And when you feel better about investing, it's probably because the market's at highs again. So good strategy is to start building cash. So you could have inside your portfolio, you could have dividends. They really should be reinvested, but you're nervous. Those dividends could just go sit in cash. So you're building up cash reserves. If you're in retirement, you should have already had a cash reserve. For our clients, we keep cash reserves usually about 2 years worth of their withdrawal expenses. They keep several months of their emergency reserves themselves in their own account. So you really should have a buffer between you and your portfolio with a cash reserve. Typically $50,000 to $100,000 is what we see for most families. But really how you have to think about this is your money is actually making money even though the price of the stocks are falling. Stocks are coming down in price, but they're still paying dividends. So for most accounts, you probably have between stocks and bonds a little over a 2% dividend yield. If you go to cash, you're not getting that right now inside your brokerage cash account. So ultimately, you have to stick the course. It could be that when the markets rebound eventually, you might need to change your risk tolerance. You might need to take some risk off the table. But for right now, you just kind of have to hunker down and keep focusing on long term. This is just a little blip along your financial path.